Alrighty. So, question for you. What do you do when your credit spreads get assigned, right? More specifically, what do you do when your bull put spread gets assigned, right? So your bull put spread is the put credit spread. So what do you do when you assign, right? So this is where a lot of people get confused, and I've got a few people that have reached out to me asking me, what they should be doing, and they're afraid that, they get a margin call and so on and so forth. So for this video, I'm going to be diving into this bull put spread assignment reversal strategy, and what it simply is just 3 simple steps to help you unwind this put credit spread assignment, and I also share with you what to do once you have unwinded it. All right, let's dive right into this. Okay, so on the left hand side, you can see that this is the chart down here, and I've put on a bull put spread down here. So the question is, when are you most likely to get assigned on your bull put spread? Right, you will most likely get assigned on your bull put spread only if your short put leg goes in the money. And short put leg, I mean this. So basically for a bull put spread, there are 2 legs. We call this the short put leg, and for the long put, we call this the long put leg. So you can only get assigned, or rather you only have a chance of getting assigned when your short put leg is in the money. That means the price has gone below your short strike of the put option. But if the price is above your short put strike, then there's no risk of early assignment at all. Right? And also when the extrinsic value of the short put leg is very little, and usually it's very little, right? When there's not many days to expiration left, you will notice that a lot of times you get assigned very close to expiration if it's in the money, maybe like 3, 4, 7 days, right? And also depending on how deep in the money your short put leg is, right? So if the market really goes all the way down, way past your long put strike, then this is what you call deep in the money. Then there is a likelihood that you could get early assigned, right? Even though there is like 30 days or 20 odd days left in your option, right? So it's very dependent on how much extrinsic value left. So this is the number that you really want to take note of when you have any in the money short put options as part of your bull put spread. So what happens when you're assigned on your short put leg? Well, basically, you'll be long 100 shares at the short put leg strike price. So you'll be 100 shares at this price down here. And then you will also still keep your long put option, right? This doesn't matter whether, the price is in between these 2 strikes, or maybe the price has gone way past, right? Because you are long the put down here, you do not get early assignment because you are the person who decide whether you want to exercise the option or not, right? So if you decide not to exercise your long put option, then there's no such thing as assignment. Assignment only belongs to short options. If you're short any option, then there will be, chance of early assignment. So when you are assigned on your short put leg, firstly, you'll be long 100 shares at the short put leg strike, and you may get a margin call if you don't have sufficient funds to buy the 100 shares, which is most likely the case for many people, right? Because most people open up their account just to trade options. They have no intention of getting long 100 shares. So when they get assigned, right, and then get long 100 shares, this is where it kind of messes up their account, because now the broker will reach out to them and tell them to top up their account because they don't have enough cash to long the 100 shares. So at this point, what do you do? So there are a few people who have mentioned that what they would do is that they will just exercise their long put option. Now, 2 things to this. Number 1, you can exercise your long put option only if the market has gone way below your this long put option, right? Otherwise, it doesn't make sense, because when you are exercising your long put option, what you're basically doing is that you're telling the broker that you want to sell 100 shares at this strike price. So if the current market is, let's say, somewhere here, which is above your long put strike, what you're essentially doing is that you have bought 100 shares roughly at this price. Let's say it's 190. And then you want to sell it somewhere around here. Let's say, for example, this is 182, right? When the current market is somewhere maybe around 184. If the market is 184, you're telling the broker you want to sell off at 182, you're taking an additional $2 loss for every share for no reason, right? So there's no point for you to exercise your long put option. Now, number 2, some people decide to actually exercise their long put option if the market has gone way past down their long put strike down here, right? So what happens is that when you do this, yes, you'll be clearing away your 100 shares, right? So your 100 shares will be gone because your long put strike essentially just sells away this 100 shares at whatever the strike price is. So in this case, let's say it's 182, but you'll be taking the max loss, right? Because you are taking the full loss from this strike to down here. So you're taking the max loss of your credit spread. But there's no reason for you to actually take max loss on this spread because your put option down here actually still have some extrinsic value, right? When there's still some extrinsic value, what it actually is some cushion for your loss on this spread. So by exercising your put option, what you're doing is that you're giving up all the extrinsic value of this put option, which is not the wisest choice, right? Instead, you want to unwind this rather than exercise your long put option. So what do? So I'm going to share with you 3 very simple steps to unwind your assignment. So the very first step is to sell off your 100 shares. So this way, you no longer get the margin call because when you sell off the shares, you get back your capital for putting up onto the for the shares. So your broker will no longer pester you anymore to keep asking you for a margin call. So now you have no position. Now the next step is to sell the original short put strike price which you put on, right? So if your strike price down here is 190 and let's say it was like, I don't know, 8 days left to expiration. So what you want to do is you go back and sell the very same strike to re-establish this put spread again. All right, and then step number 3, basically what you want to do is to do these 2 steps down here simultaneously. So if you really think about it, it's just one step, right? You just do the selling off of the 100 shares and then you sell the original strike of the short put in one order ticket, right? So this is for Think or Swim. You can see that they do this in one order ticket. Whatever platform you're using, you want to find a way to do that as well. Because while you can actually do this separately, that means you can sell off the 100 shares first, then you sell the original short put strike price. What happens is that there could be lagging risk. That means the moment you sell off the 100 shares, the market could have just gone down or gone up, right? So it would no longer be sort of like equilibrium to where you're selling your short put strike, because now your short put strike, remember, there's intrinsic value. So the intrinsic value moves together with where the current market price is. So if you do not want any lagging risk, then the best is to do this in just one order ticket like this one down here, which I'm showing you right now. All right, so basically it's just one simple step to unwind your assignment on your bull put spread, right? So it's pretty simple. So the question now becomes, what do you do after unwinding your assignment? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Because now remember, although you have unwinded your 100 shares, you have now put back on the short put strike, which had already been assigned before. So if it had already been assigned before, there's still going to be the same risk that you're going to get assigned again, right? And especially if your broker somehow charges you an assignment fee, then you're going to keep getting assigned for no reason, and then you're going to keep paying the broker this assignment fee, right? So it's best also to find brokers that do not charge you an assignment fee, by the way. So what do you do at this point of time after you have unwinded your assignment? You're still not out of the woods, all right? Because there is still always a chance that your short put strike is going to get assigned again, and it can happen as early as the same day you put on this short put strike. So there are 2 options. The first option is to roll to a further DTE, right? Let's say, for example, this is roughly around 8 days, 8 DTE. Both are 8 DTE, by the way, because you put on as a credit spread, as a bull put spread. So what you can do is take this whole thing and then you roll it to a further dated DTE, right? So maybe you roll it to the next 45 DTE. Now, one thing about this is that if you were to roll an in the money bull put spread, chances are that it will be for a debit, right? because you can only usually get a credit if this put spread is out of the money or slightly in the money. But most of the time, if it's already deep in the money, it's going to be hard to get any credit, so it'll be for a debit. So if it's for a debit, basically you'll be increasing risk on the original trade, but you get to extend the life of the bull put spread, so to speak, because if you still have a very bullish view, maybe the market can come back up, right, in the next 45 days based on the new DTE. So if it does come back up, then you can sort of like salvage the trade. But then again, it is actually just a new trade that you put on, right? So the new trade you put on is actually just an in-the-money bull put spread, which actually have a lower probability than when you first put on the bull put spread, which was out of the money. So this option, I don't really like it, although some people do want to do that. I would prefer option 2, and that is to close out for a loss, which is much lesser than the max loss, because remember, there is still extrinsic value, right, in this put spread, because there's still time before it expires. So when you close it out, it will definitely be lesser than the max loss. So that is why it's better than you just exercise this long put. If you exercise this long put, you're immediately telling the broker you want to realize the max loss, which is not the best choice, right? The better choice would be to unwind this, close out your put spread, save those few bucks, right, where you could use it for the next trade. So then once you close out for a loss, just wait for another opportunity. Remember, you win some, you lose some. Over the long term, as long as you have the right mechanics, it's going to work out for you, okay? So the next question to bring about this is how to actually prevent this whole mess in the first place, because it gets a little bit messy when you start to get assigned on your bull put spread. So rather than trying to cure it, we want prevention. That is why there's this saying, prevention always better than having a cure, right? So how do you reduce the risk of early assignment? Well, two answers to this. The first one is just exit at 21 days to expiration. Basically just means that there's 21 days to the expiration of the options. Of course, you do this only when the short put leg is in the money. If it's out of the money, then there's no need for you to do anything, right? Because there's no risk for early assignment. At the same time, when you exit at 21 DTE, as you can see, this is a study that I've shown before, that when you exit at 21 DTE, you still get a superior performance than holding to expiration. So there's no real need for you to hold all the way to expiration. Now, the second answer is to avoid all this early assignment. What you could do is just to trade the cash settled index options, right? For example, the SPX, XSP, NDX, RUT, MRUT, and so on and so forth, right? So basically with cash settled index options, these are what you call European style options. So I mentioned this as well in a number of my videos. So basically European style options are the opposite of what you call the American style options on those index ETFs, and as well as your stocks, right, your equities. So when you trade the European style index options, or rather European style options, what happens is that there is no early assignment. So if there's no early assignment, you can actually take this whole spread all the way to expiration, right? Even though there's maybe like 3 days left, or maybe even 1 day left, you don't have to worry about early assignment, because this is a European style option. So what happens is that at expiration, they will see that whether you're in a profit or a loss, and they will tabulate that, and then they will put it into your bank balance, right? If you lose money, you'll be taken out of your balance. If you're going to make money, they're going to put a credit into your trading account balance. So guys, if you are afraid of getting an early assignment, then exit at 21 DTE, or just simply trade the cash settled index options, and you will have no worries about getting any early assignment. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.